Hi, I'm Rich Erwin, Chief Investment Officer of IAM. Leanne, DeVey, and I are at the Morningstar Investment Conference in late June in Chicago, where we found a quiet corner of McCormick Place, where the convention center is, to do this recording. We've been attending lots of meetings. One of the ones we went to this morning was titled Equity Valuations, the Good, the Bad, and the Ugly. And they had three really outstanding speakers, and I just wanted to sum up some of the thoughts that they shared with us. The first one was Mason Hawkins from Southeast Asset Management. He's been managing a Longleaf Partners fund for a very long time. In his opening remarks, he showed a chart and showed something called earnings yield. And what that is, it's the earnings of a company divided by its price. And that's historically pretty high, but he compared it to the interest rate on U.S. Treasury notes, 10-year notes. And he showed historically, going back to the 50s, how that valuation was today, the spread between the earnings yield and the interest rate. And it was the third highest, or one of the top three levels since the 50s. The other two were 1953 and 1978. Now, in those past periods, over the next 1, 3, 5 years, returns on stocks were anywhere from the high teens to the low 20s on average per year. So there's a precedent for, at these levels, for stocks to do quite well, according to Mason Hawkins. And he said, we believe ownership has a terrific place in your portfolio vis-a-vis bonds. So in other words, as a long-term investor, stocks look much more attractive than bonds, in his opinion. Now, he also said that one of the issues, one of the challenges today is top-line growth. In other words, revenue growth from companies is very anemic because the economy is slow. And he said you really have to look for places where there is top-line growth. And one of the areas that he suggested was natural gas. He was really high on the amount of natural gas reserves we have in America today. And he says it might be the most important thing we have in America is our natural gas supply. And he talked about how more switching natural gas would have a good environmental impact, it would create jobs, would replace coal, would reduce energy imports, and eventually lead to exports. He said exports could follow in 2014 to 2015. And much as we've all been hearing lately, he's predicted that more and more trucks will be moving to liquefied natural gas as a fuel. Now, another speaker we had, his name was Steve Romick, and he was from First Pacific Advisors. Now, I've heard Steve a couple of times, and he's a very good thinker. He was concerned about our U.S. debt. He said 41% of our country's debt matures by the end of 2013. So it's very short term. We're borrowing short term, he said. Interest expense right now is 6% of the U.S. budget. Back in 1970, when interest rates were much, much higher, it was 7%. But we have so much more debt now at very low interest rates, and if interest rates went to 5 or 6%, it would substantially increase the U.S. deficit. And that was something he said was very much worth tracking and watching. Let's see, I had one other comment from Steve. He was also watching corporate profit margins very closely to see if they could be maintained. And the feeling was around the table that maybe they could, because more and more of our lower margin businesses have been moved offshore, and more profitable ones left in the U.S. Okay, so now the third speaker was a man named Doug Ramsey with Luthold Funds. And he said the question really related to investors. Individual investors are not putting money in the market, they're taking it out. And can the market go up in such an environment? And he said in the 70s we had strong equity gains without much fund inflow. Also, he cited more recently in March of 2009 to early 2012, while the market doubled, investors really weren't putting new money in the market. In fact, just very recently, from October 11th to March 2012, from October 2011 to March 12, there were no new inflows, but the market rallied 29%. He said the lack of interest by individual investors is a contrary indicator. So what that means is most people get it wrong. Most people take money out when they should be putting it in. And so the fact that people are taking it out and putting it in bonds is a good indicator for stocks, but it's unfortunate for those individuals who are moving out of fear and are going to miss an opportunity. He said the typical individual U.S. investor has historically bought at 20 times earnings and sold at 15 times earnings. So bought when they're expensive, sold when they're cheap. Last point, he talked about European stocks, and he said the valuations were very cheap, under 10 times earnings, historically way below average, and that the European stocks are close to discounting zero growth. But remember, they have 4.5% dividends on average, and they also, many of those companies do business outside of Europe and in the US and in the emerging markets. So there's more to it than just being a European company. So those are giving us some ideas about opportunities that might be available in the markets as we look long-term out to the next few years. We'll report back to you on more after a future meeting. See ya.